Charting your course, the power of financial goals. Investing your money wisely is like building a house. You wouldn't start without a blueprint, right? Financial goals are your blueprints. They give you direction and purpose.
Think about what you want to achieve. Do you dream of retiring early, buying your dream home? These goals will shape your investment strategy. A clear goal helps you stay focused. It motivates you to save and invest regularly. Remember, investing is a marathon, not a sprint.
Knowing your limits. Understanding risk tolerance. Risk tolerance is how much uncertainty you can handle with your investments. It's a measure of your emotional and financial capacity to endure the ups and downs of the market. Are you comfortable with the possibility of losing money for potentially higher returns? This is a critical question every investor must ask themselves. Or do you prefer slow and steady growth with lower risk? Understanding this preference can guide your investment strategy. Knowing your risk tolerance is crucial. It's not just about your willingness to take risks, but also your ability to withstand financial losses. It helps you choose investments that align with your comfort level. This alignment can prevent you from making hasty decisions during market volatility.
If you're not comfortable with high risk, you'll panic and sell at the wrong time. This can lead to significant financial losses and missed opportunities. Take some time to assess your risk tolerance honestly. Reflect on past experiences and how you reacted to financial stress. There are online questionnaires and financial advisors who can help. These tools and professionals can provide valuable insights into your risk profile. Remember, investing should be about building wealth, not giving yourself sleepless nights. A well-balanced portfolio that matches your risk tolerance can help you achieve your financial goals while maintaining peace of mind.
The Investor's Toolkit, exploring investment options. The world of investing offers a wide array of options. You've got stocks, bonds, mutual funds, real estate, and more. Each comes with its own set of risks and potential rewards. Don't be intimidated.
Take the time to educate yourself. Learn about different investment vehicles and how they work. There are tons of resources available. Read books, attend seminars, or talk to a financial advisor. The more you know, the better equipped you'll be to make smart investment decisions.
Building a solid foundation. Creating a budget. Before you even think about investing, you need to get your financial house in order. That starts with creating a budget. A budget is simply a plan for your money. It tracks your income and expenses, so you can see where your money is going.
Once you have a clear picture of your cash flow, you can identify areas to cut back and free up money for investing. Remember, you can't build wealth if you're spending more than you earn.
Life is full of surprises, and not all of them are good. Your car could break down, you could lose your job, or you could face unexpected medical bills. That's where an emergency fund comes in. It's a stash of cash set aside for life's unexpected events. Aim to save enough to cover 3 to 6 months of living expenses. Having an emergency fund gives you peace of mind and prevents you from going into debt when the unexpected happens. It also protects your investments, so you don't have to sell them at a loss when you need cash quickly.
High-interest debt, like credit card balances, is a major roadblock to building wealth. The longer you carry high-interest debt, the more money you're throwing away on interest payments. Before you start investing, make it a priority to pay off your high-interest debt. Consider using the debt snowball method. List your debts from smallest to largest, and focus on paying off the smallest one first. Once that's paid off, roll the amount you were paying into the next smallest debt. This creates momentum and keeps you motivated as you chip away at your debt.
Now that you've laid the groundwork, it's time to define your investment strategy. This is where your financial goals, risk tolerance, and time horizon come together. Your time horizon is how long you plan to invest your money. If you're saving for retirement in 30 years, you have a long time horizon. If you're saving for a down payment on a house in 5 years, you have a shorter time horizon. Generally, longer time horizons allow for riskier investments. You have more time to recover from any market downturns. Shorter time horizons require more conservative investments to protect your principal.
Long-term growth. Exploring the stock market. When it comes to long-term growth potential, the stock market is hard to beat. When you buy stock in a company, you're buying a small ownership stake in that company. Historically, the stock market has provided an average annual return of around 10%. However, it's important to remember that past performance is not indicative of future results. Investing in the stock market carries risk, but it also offers the potential for significant returns over time. If you're investing for the long term and have a higher risk tolerance, stocks can be a valuable part of your portfolio.
Fixed income and stability. Understanding bonds. Bonds are essentially loans that you make to governments or corporations. When you buy a bond, you're lending money to the issuer for a fixed period of time at a fixed interest rate. Bonds are generally considered less risky than stocks, but they also offer lower potential returns. They can be a good option for investors who are looking for income or who want to diversify their portfolio and reduce overall risk. There are many different types of bonds available, so it's important to do your research and choose bonds that align with your investment goals and risk tolerance.
Diversification, the key to balanced investing. It's a fundamental principle that every investor should understand and implement. Diversification is the practice of spreading your investments across different asset classes, industries, and geographic regions. This strategy helps to mitigate risks and can lead to more stable returns over time. The goal of diversification is to reduce risk and enhance returns. By not relying on a single investment, you can protect your portfolio from significant losses. Think of it like this: don't put all your eggs in one basket. If one basket falls, you still have others to rely on. By diversifying your portfolio, you're reducing the impact that any one investment can have on your overall portfolio. This means that the poor performance of one investment won't drastically affect your overall returns. There are many ways to diversify your investments. You can choose from a variety of strategies to suit your risk tolerance and investment goals. You can invest in a mix of stocks, bonds, and other asset classes. Each asset class behaves differently under various market conditions, providing a balance to your portfolio. You can also diversify within each asset class. For instance, within stocks, you can invest in different sectors such as technology, healthcare, and finance. For example, you could invest in stocks of companies of different sizes, industries, and geographic locations. This approach ensures that your investments are not overly concentrated in one area, reducing the risk of significant losses. Over time, a well-diversified portfolio can provide more consistent returns and help you achieve your long-term financial goals. Diversification is not just a one-time activity, but an ongoing process that requires regular review and adjustment. Regularly reviewing your portfolio and making necessary adjustments ensures that your investments remain aligned with your financial objectives and market conditions. Remember, diversification is a key strategy for balanced investing and long-term success.
The journey to financial freedom, informed decisions, and consistent action. These are the cornerstones of achieving financial independence. Mastering your money and achieving financial freedom is a journey, not a destination. It's a path filled with learning, growth, and strategic planning. It requires informed decision-making, consistent action, and a long-term perspective. Remember to set clear financial goals to guide your investment strategy. These goals act as your roadmap, helping you navigate through the complexities of financial planning. Understand your risk tolerance and choose investments that align with your comfort level. This means knowing how much risk you can handle without losing sleep at night. Educate yourself about different investment options and seek professional advice when needed. Knowledge is power, and in the world of finance, it can be the difference between success and failure. Create a budget, build an emergency fund, and prioritize paying off high-interest debt. These foundational steps ensure that you have a solid base to build upon. Define your investment strategy based on your time horizon, risk tolerance, and financial goals. A well-thought-out strategy can help you stay focused and disciplined. Diversify your investments to reduce risk and enhance returns. Diversification is like not putting all your eggs in one basket. It spreads risk across different assets. Investing can be intimidating, but it doesn't have to be. With the right knowledge and tools, anyone can become a successful investor. By taking the time to educate yourself and make informed decisions, you can build a brighter financial future for yourself and your family. Attend workshops, read books, and stay updated with financial news. Remember, the best time to start investing was yesterday. Time is one of the most powerful tools in investing, thanks to the magic of compound interest. The second best time is today. Don't wait for the perfect moment. Start now and let your money work for you. So take control of your finances and start building your path to financial freedom. With informed decisions and consistent action, you can achieve the financial independence you desire. Celebrate your milestones along the way, and remember that every small step brings you closer to your ultimate goal. Reflect on your journey, learn from your experiences, and continue to grow. Financial freedom is not just about having money, it's about having the peace of mind and security to live life on your own terms.